Welcome back to the Deep Dive. This is the place where we take on the toughest topics in finance. And, well, we break them down piece by piece until you really get to the core of it. Today we are tackling what is, I would argue, the most crucial conceptual area of ACCA financial management. We're doing a deep dive into investment appraisal under risk and uncertainty. And just to be clear, we are not here to walk you through the mechanics of a cash flow table. We're assuming you're already proficient in calculating a basic net present value, an NPV. Our mission today is, it's a higher level one. We want to help you master the judgment, the evaluation, and the kind of robust discussion you need to secure those top professional marks in the exam. We're going beyond the math and into the mindset of a successful financial manager, a mindset that is, and this is key, deeply examiner aware.
That is such an important distinction to make right from the start. That shift in focus is absolutely essential. Look, the standard NPV calculation is a wonderful tool, it really is, but it operates in a sort of vacuum. It's built on this ideal, this flawed assumption that all your future cash flow estimates are perfect and certain. In the real world, and therefore in a professional finance exam, that idea of certainty it's immediately dismissed. Think for a moment about what a financial manager actually does. They are the gatekeepers of capital. They decide where the company's limited resources are going to go. Are we launching that cutting-edge new product? Are we building a huge new factory? Venturing into a new market in Asia? Every single one of those decisions is fundamentally intrinsically risky.
So the exam isn't just a test of our ability to press buttons on a calculator. It's testing if we can think like an investment analyst who truly understands that the future is, well, unknowable.
Precisely. You have to demonstrate that you understand not just how to calculate a positive number, but also the profound fragility of the estimates that underpin that number. The second you introduce any kind of forecast, sales volume, material costs, project life, you introduce uncertainty. So this deep dive is all about how you can structurally address that uncertainty in a way that's going to satisfy the examiner.
Okay, let's unpack this then. This core issue of risk. Why is it that examiners place so much weight on the evaluation of risk when so many students, they focus all their energy on perfecting that initial cash flow schedule?
It all comes down to the most foundational principle in all of capital markets. The risk-return trade-off. It's just inescapable. It informs every single pricing decision in finance. In simple terms, the higher the level of risk you're being asked to take on, the greater the return an investor is going to expect as compensation for bearing that risk.
Okay, so it's a direct relationship.
A direct relationship. We can see this really clearly. Imagine an investor putting their money into two different things. On one hand, you've got a simple deposit account at a high street building society that's very, very low risk. It's safe, it's predictable, it's regulated, and correspondingly, the return is minimal. On the other hand, imagine buying shares in a volatile tech startup. Now that carries significant risk. You could lose a lot of your capital, the company could even fail. So because of that risk, the investor demands a much, much greater potential return to compensate them for accepting that higher volatility. That difference in expectation is the risk-return trade-off in action, constantly.
And what makes this so challenging in a corporate setting is that this relationship between risk and return is, well, it's subjective, isn't it? My attitude to risk is going to be completely different from yours.
Absolutely. One manager might be very risk averse, they'll
Right.
prefer lower stable returns. Another might be a risk seeker, happy to chase those highly volatile, potentially spectacular returns. And it's because of this managerial subjectivity that we can't just rely on gut feeling. We need robust, objective, analytical tools to actually quantify and manage risk inside a company.
So if we bring this back to a capital investment decision, the core problem is one of foundations. We can calculate this wonderful positive NPV, but that positive number is relying on, maybe 5 or 10 years of forecasts, all holding true. Sales volume, material costs, inflation, exchange rates. It really does feel like a massive leap of faith built on sand.
It's a conceptual risk, exactly. The initial NPV model, by its very design, assumes certainty. You plug in one figure for sales, one for costs, and it spits out one NPV. But in reality, every single one of those future cash flows is uncertain. And here's the crucial conceptual distinction you have to get into your exam commentary. Uncertainty compounds with time. The further into the future you forecast a cash flow, let's say year 7 or 8, the more and more uncertain that estimate becomes. Time itself is the great risk multiplier in investment appraisal.
That makes perfect sense. Predicting the cost of materials for next year is far easier than trying to guess what they'll cost in 2035.
Of course. And so the financial manager's job is so much more nuanced than just checking if a number is positive. Their job is to set the right criteria for accepting an investment. If a project is inherently riskier than the company's normal business, if it has a steeper, more uncertain cash flow profile than the required return, the benchmark, the acceptance criteria, all of it must be adjusted to reflect that higher risk. We're always looking for that balance point.
Okay, so if certainty is a conceptual lie in financial modeling, we need some tools to introduce a bit of reality. Let's pivot to those tools. The syllabus gives us, 4 main ways to layer reality onto that pristine initial NPV. We've got sensitivity analysis, expected values, simulation, and then using payback period in a strategic way.
Let's start with the big one, sensitivity analysis, or SA. This is a staple of the FM paper, and it's really designed to ask a very simple question. How much wiggle room do we have before the project collapses?
Okay.
What one SA does, mechanically, is it analyzes the effect of changing your key variables. So sales price, sales volume, initial costs, to see how big an impact they have on the final decision. The technical aim is to calculate the percentage change, the sensitivity in each of those variables that would cause the project's net present value to fall to precisely 0. That 0 point is your financial break-even.
Yeah, the calculation itself is pretty straightforward, right? It's the NPV divided by the discounted cash flow of that specific variable. But like we said at the start, the power here isn't in the percentage, it's in the judgment we apply to it.
The judgment is everything. By finding the most sensitive variables, the ones that need only the smallest percentage change, say a 2% drop in sales, to completely destroy the project, the company instantly knows where its estimates are most fragile. Those are the areas that need urgent investigation or some kind of management control. If your $1 million NPV becomes 0 with a 50% rise in fixed costs, that's probably not a major concern. But if it turns negative with just a 1.5% rape in the selling price, well, that variable is now mission critical.
And here's where those high-level professional marks come in. What is the fundamental conceptual error that you see students making when they write about sensitivity analysis?
It's the failure to move from diagnosis to action. Most candidates will stop at the statement. The sales volume is the most sensitive variable at 3%. And that's it.
So they've identified the risk.
They've identified the risk exposure, but that's all. The examiner wants to see the discussion move into the operational and strategic world. SA doesn't tell you the likelihood of that 3% change happening. It doesn't automatically tell the CFO what to do. To get those professional marks, your discussion has to transition. It needs to say something like, because sales volume is highly sensitive, management should now take action. Quote. This might involve implementing more rigorous controls on our sales forecasts, maybe commissioning better market research to confirm demand, or even strategically locking in a minimum sales price with derivatives to create a buffer. It's about remediation and control, not just measurement. That depth shows the difference between a student who can calculate a number and one who can manage a risk.
That's a really powerful distinction. So SA deals with exposures. Let's look at a tool that tries to deal with likelihood, expected values, or EV. How does this tackle uncertainty differently?
Expected values try to inject probability directly into the appraisal to find an overall average outcome. So instead of just assuming one single figure for sales, you identify multiple possible outcomes. You might say there's a 20% probability of low demand, a 60% probability of medium demand, and a 20% probability of high demand. You assign these probabilities, calculate the NPV for each of those scenarios, and then you find the weighted average NPV.
So we're no longer relying on a single, potentially biased estimate. We're using the most likely average outcome.
Yes, but this is where the limitations are so crucial for your exam discussion. EV relies purely on an average, and that average can often mask some really severe underlying risk. It completely ignores the range of possible outcomes, especially the downside risks, and most importantly, it ignores the risk preference of the person making the decision.
But isn't an average better than nothing? I mean, if we don't use EV, we're back to relying on one single, maybe biased forecast.
It is better, but it's incomplete, especially for big strategic decisions. For example, imagine 2 projects, and both have an expected NTV of $500,000. Project A's outcomes range from $400,000 up to $600,000. Pretty tight. Project B, however, has outcomes ranging from a loss of $5 million to a gain of $6 million. EV treats them as identical, but clearly, Project B carries an existential risk to the company. Relying only on the average for Project B, a one-off strategic investment that could bankrupt you if the worst case hits, well, that would be negligent. This really highlights that EV is best for repetitive, low-risk operational decisions, like deciding which inventory system to use, where the average outcome will eventually happen over many trials. For a unique, once-in-a-decade strategic investment, the decision maker has to factor in their tolerance for those extreme downsides, no matter how positive the average looks.
That leads us nicely, conceptually at least, to the most advanced probabilistic tool, simulation, which people often know as Monte Carlo simulation. We don't need to get into the mechanics, but what's the conceptual output the examiner expects us to understand?
Simulation is all about generating a massive range of future realities. Thousands, sometimes millions of iterations. Conceptually, what you do is you assign probability distributions to all of your key variables, sales, costs, exchange rates, everything. Then the model just randomly picks values from these distributions based on the probabilities over and over again. And by running the simulation thousands of times, you end up with a full probability distribution of all the possible NPV outcomes. So the output isn't a single expected NPV. It's a statement like this. There is an 85% probability that the project NPV will be positive, and there's a 5% chance that the loss will be more than $10 million. It's just a far more comprehensive map of the future.
Right. And finally, let's look at the much simpler, faster tool that actually becomes more relevant when uncertainty is high, the payback period.
The payback period is just the time it takes for a project to recoup its initial investment in pure cash terms. In isolation, it gets a lot of criticism because it ignores the time value of money and, any cash flows that happen after the payback. However, it is an excellent risk management tool precisely because it focuses on time. And since we know uncertainty gets worse with time, prioritizing projects with a shorter payback period, say getting your money back in 2 years instead of 6, directly mitigates uncertainty. It means the company is exposed to that cash flow volatility for a much shorter period, increasing the certainty that at least the initial capital will be recovered.
So it's an operational declaration, really, isn't it? The company is saying that the speed of recovery is more important to them than maximizing a long-term but highly uncertain return.
Absolutely. And to give it more rigor, which is what you should do in the exam, you should mention the discounted payback period. This variation incorporates the time value of money by discounting the cash flows before you calculate the recovery time. And that strengthens its role significantly, making it a really robust measure for risk-averse companies who are prioritizing fast capital recovery.
Okay, that section focused on managing risks specific to the project's variables, the risk of our sales estimates being wrong. But investment appraisal needs to bring in a much broader layer of risk, the fundamental risk that the market requires us to compensate for. And this takes us into the world of risk-adjusted discount rates, RADR, and the capital asset pricing model, CAPM.
This is a fundamental shift in our thinking. We're moving from unsystematic risk to systematic risk. And we have to establish the difference between these two categories of business risk first. It's essential. So, first, you have unsystematic risk. This is often called company-specific risk. It comes from internal factors that are unique to that one firm. A poorly managed supply chain, bad labor relations, a terrible marketing campaign. Now, the crucial point here, which comes from modern portfolio theory, is that a shareholder who holds a well-diversified portfolio of shares, say across 50 different sectors and countries, can effectively diversify this risk away. The poor performance from a strike in one company is canceled out by the runaway success of a different, unrelated company in their portfolio.
So if the investor can just get rid of this risk by spreading their money around, they're not going to demand any extra compensation for it. It's their job to diversify.
That's exactly right. The market assumes diversification is free and easy. Then we have the second type, systematic risk or market risk. This risk is due to general macroeconomic factors that affect all companies at the same time. A nationwide recession, a sudden spike in global interest rates, major geopolitical events. This risk cannot be removed through diversification. It's just part of being in the market. And the entire foundation of CAPM rests on this idea. Because shareholders are assumed to be rational and well-diversified, the return they require from an investment is determined only by the level of systematic risk that company exposes them to.
Right. And this brings us back to the default discount rate most students use, the WACC. So if the WACC is the current required return for the company as a whole, why can't we just use that discount rate for every new project we look at?
The WACC is a beautiful average, but it's a measure of the risk of the existing company, as it is right now. It is only appropriate for a new project if two conditions are met. One, the project has to carry the exact same level of business risk as the company's current operations. And two, the project has to be financed in a way that keeps the company's current debt-to-equity ratio, or its gearing, the same. If the new project involves a big change in business risk, let's say a textile manufacturer suddenly decides to invest heavily in autonomous drone technology, that project is inherently riskier than their average operation. Shareholders will demand a higher return for that extra systematic risk. In this case, the current WACC is too low. We have to calculate a project-specific risk-adjusted discount rate.
Okay, and what about the financing? If the gearing changes, why does that alter the cost of equity?
This really gets into the work of Modigliani and Miller, M&M. If the company takes on a lot more debt to finance this new project, the leverage increases. Now, although debt interest is tax-deductible, that higher level of debt fundamentally increases the financial risk for the existing shareholders. M&M showed that as gearing goes up, the residual earnings, the profit left for shareholders, becomes much more volatile. And because the shareholders are now bearing more volatility, they demand a higher return to compensate. So the cost of equity goes up, the WACC changes, and you need a specialized discount rate that reflects that new financial structure. This is what forces us to introduce the beta factor. Beta is the quantitative measure of systematic risk used in CAPM. It measures an investment systematic risk relative to the stock market as a whole, which we just standardized to have a bet of $1.
So we can think of beta as a sort of volatility multiplier. If the market sneezes, how hard does our project catch a cold?
That's a great analogy. A project with a beta of 1 moves perfectly in line with the market. If beta is greater than 1, say 1.5, it's 50% more volatile, and therefore riskier than the market average. It'll rise faster in a boom and fall harder in a downturn. Conversely, a beta less than 1 is less volatile, and the theoretical benchmark of beta of dollars is the risk-free investment, usually assumed to be short-term government securities.
The examiner will often give us the CAPM formula itself, text RF while F. Let's just break this down slowly and conceptually for the listener. What are the building blocks of this required return?
The formula elegantly breaks down the required minimum return into 2 parts: compensation for time and compensation for risk. The first term, or R1, is the risk-free rate. This is the return you get just for giving up your money for a period of time without taking on any systematic risk at all. The second part is the risk premium, and this is where all the action is. RFSDE. Inside the brackets, text ERF1 is the market risk premium. That's the extra return the general stock market provides over and above the risk-free rate. It's the market's baseline payment for bearing systematic risk. We then multiply this market premium by our specific investment's exposure, which is its beta fac.
So if my project is riskier than the market, with a beta greater than 1, I get a larger slice of that market premium pie.
Exactly. The final required return is you get your money back for waiting, plus a bonus that is tailored specifically to the amount of systematic risk you are taking on, the risk premium. This resulting rate is the risk-adjusted discount rate, or RADR, which we then use in our NPV calculation. Using this tailored rate ensures we only accept projects that generate enough return to compensate our shareholders for the specific systematic risk they're exposed to.
Okay, we've covered the mechanical tools, the probabilistic tools, and the market-driven risk adjustments. Now we get to the most important part for exam success: applying judgment and context. We really need to focus on how to secure those crucial professional marks in the discussion and critique sections of the exam.
This is absolutely where the exam is won. The key to professional marks is showing critical thinking that goes beyond just the numbers on the page. When you're discussing an investment decision, you have to look past the calculated NPV and rigorously critique the core assumptions and the inputs that went into it. Let's start with a really big one: inflation. If inflation is present and relevant in the economic environment, and it usually is, consistency is everything. The core rule is this: you must ensure the cash flows are calculated using inflated or nominal terms, and then those nominal flows must be discounted using the nominal cost of capital, which is the rate that includes inflation, often called $8. Getting this consistency wrong is a fundamental error. If you use real cash flows uninflated with a nominal discount rate, you're using a discount rate that's too high. You're artificially depressing the NPV, and you might end up rejecting a perfectly good project. The examiner will test if you understand this.
And the link between the real rate, the nominal rate, and inflation is all defined by the Fisher formula, right?
Correct. The formula is $1 plus I, 1 plus R, 1 plus H, where $1 is the nominal rate, $2 is the real rate, and $1 is rate of inflation. You must know that if a question gives you a real cost of capital and an inflation rate, you must use the Fisher formula to find the nominal cost of capital you need to discount those nominal cash flows. Critiquing this consistency is a high-value discussion point.
Okay, let's talk about another critical input: working capital. It often seems simple, an initial outflow, and then you get it back at the end. What's the subtle trap students fall into here?
It all centers on the idea of project continuity. Let's use a quick scenario to make this stick. Imagine we're appraising a project to buy a machine to make a new kind of high-tech widget. This widget production needs, say, $50,000 in working capital for inventory and receivables. The machine itself has a life of 5 years. The trap is automatically transferring that $50,000 at the end of year 5. If the question implies that the machine will be replaced, but the widget business is going to continue with the new machine, well then that $50,000 of working capital is still needed to support the ongoing sales. In that case, the initial working capital investment should not be recovered in year 5. You only show the recovery of working capital if the entire business segment or product line is shutting down completely. It's a very common point for professional marks.
That makes the distinction crystal clear. Let's move on to tax and capital allowances. They're often a source of error just because the timing can be complex.
Tax requires very careful handling. For financial appraisals, we have to identify the taxable profit. Tax is calculated on the operating cash flows after you deduct capital allowances, which is sometimes called tax depreciation. The allowance itself isn't a cash flow, but it acts as a tax shield, reducing the taxable profit. You have to understand that tax authorities usually let you deduct a percentage of the asset's value each year, the tax allowable depreciation, or TAD, which is a great benefit. The resulting tax cash flow is then typically lagged, so it might be payable 1 year in arrears. You have to trace that timing very carefully. Profit calculated in year 1 leads to tax due on that profit in year 1, but the tax cash outflow actually happens in year 2. Failing to lag the tax outflow correctly is a major deduction of marks. Always check the specific tax rules in the question.
Let's go back to the beta concept for a moment, specifically the conceptual understanding of asset beta versus equity beta. Why is this conversion so critical for high-level judgment?
This is core M&M theory again. The beta you see for a listed company, that's called the equity beta. It measures the total risk shareholders face, which is a combination of 2 things: the company's underlying business risk and its financial risk, so the effect of its debt. But when we appraise a new project, what we really need is to isolate the pure risk of the business activity itself. And that's the job of the asset beta. It strips out the financial risk component. Here's the conceptual flow you need to understand. If we're appraising a new project that's totally new for our company, we go and find a comparable company in that new industry, and we find its equity beta. But that competitor's equity beta reflects their level of debt. We can't just use it directly unless we happen to have the exact same financing structure, which is unlikely.
So we have to adjust it.
We have to adjust it. We must conceptually know that there's a formula to ungear the competitor's equity beta to find their pure asset beta, just the measure of business risk. Once we have that pure asset beta, we then re-gear it using our company's specific target financing structure to find the right equity beta for our project. And that finally lets us calculate the required risk-adjusted discount rate using CAPM. It's a process that ensures the discount rate correctly reflects both the risk of the project and the specific financing risk our own shareholders will have to bear.
So it's essentially tailoring the competitor's risk profile to fit our specific corporate structure.
Absolutely. The examiner expects you to recognize conceptually that this conversion, taking out their debt effect and then adding back our own debt effect, is necessary whenever a new project's business risk or financial structure is different from our company's average.
Finally, let's wrap up by critiquing the models themselves. Examiners love testing critical thinking. What are the major established limitations of CAPM that you should be ready to discuss?
You should always have 2 or 3 strong limitations ready to go. The first is simply the challenge of estimating the inputs. It's often very, very difficult to accurately estimate a project's beta. For novel or unique projects, finding a truly comparable company, one that operates solely in that niche area and has a reliable beta, can be almost impossible. So we end up relying on imperfect estimates, which compromises the model's accuracy from the start. The second major limitation is the model's core assumptions. CAPM assumes perfect capital markets, that information is free, all investors are rational, they can borrow and lend at the risk-free rate, and there are no transaction costs. And while that's useful as a theory, those conditions just don't exist in the real world.
Right, it's a theoretical model.
It's a theoretical model. And thirdly, as we touched on, CAPM was developed as a single-period model, a 1-year framework. But in practice, most of our investment projects run for many, many years. Applying a single static required return over a multi-year project, even if you calculated it using CAPM, is a huge simplification. It ignores the fact that market risk and investor requirements change over time.
So given all of these risks and variables and calculations, what's the default assumption a candidate should fall back on if they're in an ambiguous exam scenario?
It comes down to clarity and justification. If the question gives you absolutely zero information suggesting a change in business risk or financial gearing with a new project, you must default to the most practical assumption, that is, Assume the WACC remains unchanged and use the current calculated rate. That is your safe default starting point. However, the moment the question introduces a change, it mentions elevated risk, a new market, a different product, a massive debt injection, you must recognize that the WACC is now inappropriate. You then have to use the tools we've discussed, SOAEV or RADR, using CAPM to evaluate that impact. The majority of your professional marks hinge on correctly identifying why the standard assumption fails and how you propose to adjust for the risk. That shows true financial management capability.
That is fantastic guidance. This deep dive has, I think, really moved us from just calculating the NPV to mastering the critical thought process that validates it. And that's exactly what the FM paper demands. Okay, to summarize our deep dive into investment appraisal under risk and uncertainty, you really need two key conceptual shifts for guaranteed exam success. First, you need to recognize that every single variable you estimate is an inherent risk exposure that requires checks like sensitivity analysis and, crucially, follow-up management actions. And second, you have to understand that the correct discount rate is fundamentally dependent on the project's systematic risk exposure. This forces you to constantly ask, is our company's WACC still valid, or do we need a tailored risk-adjusted discount rate using CAPM?
And here is a final provocative thought for you to take away. The choice of appraisal technique isn't just a mathematical exercise, it's a declaration of corporate culture. When a highly risk-averse company chooses to rely heavily on a short payback period for project acceptance, what they're essentially declaring is, we value the speed of capital recovery over the potential size of a long-term, highly uncertain return. Contrast that with a company using Monte Carlo simulation. They value a deep understanding of probability distributions over quick simplicity. So think about how a company's risk culture dictates which tool gets prioritized and how that ultimately influences their entire investment strategy.
That is a powerful and very practical framework to end on. Thank you for joining us for this essential exam-focused deep dive. We really hope this discussion provides the conceptual clarity and strategic edge you need to master the FM paper. If you found this discussion helpful for your ACCA studies and you want more detailed guidance on professional marks and exam technique, make sure you access the full suite of resources from our partners. You can subscribe to the SmartPass YouTube channel. That's at https://www.youtube.com/SmartPassACK They have detailed lectures and study guides that cover the whole ACCA syllabus. You can also follow SmartPass on Instagram for daily ACCA exam tips designed to keep you sharp and focused on the key examinable areas. That's https://www.instagram.com/ACCASandSmart.pass. And finally, you can access premium ACCA FM study kits and detailed exam strategies on Gumroad at https://akasmartpass.gumroad.com. Keep digging, keep learning, and we'll catch you on the next deep dive.